Okay, hi everybody. It's Monday the 12th of July, and this is Accounting 121. In today's recording, I'm going to give a short introduction on what's happening in the world, which I don't generally try and do when I give my lecture tonight. Which my lecture tonight will be on Chapter 8. 6 and 7 we just did, and with the break, we had a break for July 4th and some technical difficulties in WebEx last Monday, yes, or the Monday before, and so I did make some recordings, and you'll find them here in. I made me small, so let's get over here. I'm in my office in Rifle. So here's our course. If you are behind, catch up. Let's go. Time to get moving. But here in Cisco WebEx, there's a number of recordings. I left links to them too. I think I made an announcement here. I'll go through that. There's a Chapter 7 lecture. And I also put it up on YouTube. So obviously there weren't issues of. I don't throw my other lectures up on YouTube in case I don't have privacy. Y'all didn't write off on privacy. If you happen to be in the audio of the lecture, I need to ask you if I could, use your audio in there. So I don't put those up, but if I'm by myself like this, I will put this up on YouTube. Let me just glance down here, make sure that I'm recording. Start virtual camera. Oh, yes, I am recording. This is OBS software. I think I told you that before. This is a free software and works really well for me. Stitch people use it a lot. Anyhow, we're going to go into Chapter 8 tonight, but I'm going to go into Chapters 6 and 7. So you can see the lectures for 6 and 7 are here on your Canvas, in the Canvas software, as well as in the WebEx software, and additionally, you can go find them on YouTube if you want to go in that way. So with that, I'm going to go get to my section of McGraw Hill. But for a moment, I just wanted to touch base with you a little bit. I happen to think, and one of the reasons that I teach is because I think we're at a very important crossroads, and as a nation, as a people, and people of the world, if you will. As you know, I've shown you this problem, and this is an accounting problem. The U.S. national debt is rising at an alarming rate, and I want to let you know that that's of grave importance to me. If assets equal liabilities and owner's equity, the U.S. government is not revealing the essentials of its accounting to regular people. And I'm of the belief that accounting is not particularly difficult, or most people can get through it, even if you're, the average person can take a look at the accounting equation or take a look at a balance sheet and understand what's going on with a little bit of teaching, and I think that teaching should take place in high school. I think economics is very important in high school, but economics combined with a little accounting would be terrific. So this morning I was looking at the Wall Street Journal, and it's a really cool picture right there. I'm not sure where that is. Let's read. Closed restaurant in Osaka. I have a daughter that would love to go to Japan. That's so cool. Government's worldwide gorge on record debt. Gorge, that's an old word, gorge. You gorge yourself if you're a glutton. Gluttony is one of the 7 deadly sins if you look through the prism of Western civ and Judeo-Christian values. gorging yourself would be part of that sin of gluttony. And it's important to know that. It's important to know where these terms and ideas come from in order to read the newspaper. In my opinion, the writer, I don't know whether the writer knew that or the editor who made the headline, but I don't see it as a mistake. I think that's a good word. Enormous pile of savings make it possible for nations to borrow heavily at low cost. Now, in my vernacular, that's an error. There's not an enormous pile of savings. There's an enormous pile of money printing going on. And money printing is not savings. This is the difference between the Keynesian and the Austrian outlook on the world. Those are two schools of economic thought. I urge you to explore both of them. But here's what the Wall Street Journal and these writers. Now, do I have to listen to Marcus Walter and Peter Landers? No, but I can certainly look up their work and see where they come from and why they're writing this article, or maybe their unconscious bias, if you will, in this area of study. And I might look at the New York Times and see what they say about debt. Certainly, Paul Krugman is part of the curriculum here because I teach Paul Krugman, and Krugman is a Nobel laureate in economics, and we use his textbooks in my economics class. Pandemic has pushed global government debt to the highest level since World War II. Surpassing the world's annual economic output. Okay, governments, especially in rich countries, are borrowing still more, partly to erase the damage of COVID-19. So that would be one reason, the economic damage of COVID-19 led to some borrowing. Either way, the combination of huge debt and markets, meaning the possessive here, markets' lack of concern. That means the stock market, basically, the market seems to have a lack of concern. That means people. Markets are made up of people. This is the essence of free markets and individuals. Lack of concern is unprecedented. The U.S. government's on course for a budget deficit of $3 trillion and in the second year in a row, despite all the fears and inflation. 10-year Treasury bonds are yielding only about 1.33%. We're about to get into bonds and what debt is in what form it takes in capital markets, but bonds are one form. Partly because the Federal Reserve's caution about raising interest rates. I'm going to make this comment, and it may not make any sense to you, but when the debt is here, the Federal Reserve cannot increase interest rates because the budget of the United States will be broken. If interest rates go up 100 basis points, or from 1 to 2%, from 1% to 2%, it would add at least $500 billion, $500 billion, to the budget deficit that we're already running at $3 trillion. So in other words, if the U.S. government is borrowing for operations, it's as if you had a ski shop and you borrowed all the time to make payroll. Eventually, no one would loan you money anymore. Unfortunately for the United States, or fortunately, and if you're on the other side of that debate, people loan money to the United States in order to operate, in order to pay. We pay our bills. I say we, the U.S. government. I don't feel a part of that. I feel like I'm American, but I'm not a part of a government that would spend in deficits like that. I don't, and by the way, that it's not a red or blue. There's two big parties in the United States. One is the Republicans and one is the Democrats. Both spend at the same rate. So there's I don't discern any difference between the two. So you know, if you're one of those people who's been made to think that red guy bad, blue guy good, or blue guy bad, red guy good. I don't see it. And of course, the executive is only one branch of the government, and the executive does what the legislative branch tells him to do, him or her, vis-a-vis spending. So Japan's central government debt is about to surpass a quadrillion yen, or nearly 10 trillion. Well, 250% of gross domestic product. When is this a problem? Well, we can look at public debt, bond yields, and public debt. There's a lot of ways to look at this. I urge you to take a look at this article in your travels and understand how much our sovereigns meaning governments, are borrowing. I don't think it's sustainable. As a matter of fact, I know it isn't. It's not something that it's a matter of timing. Will it collapse in my lifetime? Will it collapse in your lifetime? It's hard for me to tell. I've thought it would since 1971, when we went off of the gold standard. I was a young man by the time I was aware what the government had done as far as the currency went. I've been calling for a currency collapse since at least 1980, but even before that, when I started working on Wall Street. So, but here's an interesting thing: this inflation indicator. A lot of you are unaware that the dollar has lost its value due to this printing of money, and this inflation calculator starts at 1913, not by mistake, but because in 1913 was a very bad year for the United States, in my opinion, because 1913 was when we created another central bank, and that is the Federal Reserve that we have today. And obviously, I'm not a Federal Reserve fan, so there you go. In 1913, if you purchase an item for $1, in 2021 you'd have to pay $27. So the rate of inflation, the cumulative rate of inflation, is at 2,619%. Now, you're going to learn and be told in different classes that inflation is created by greedy capitalists or greedy free market people. That's not true. That's a false narrative, and I can tell you why. And the reason is that inflating the currency is what causes price inflation. So when you manipulate the currency, and we have a currency that's not based on any commodity, when you increase the volume of the currency, how much currency is out there, you will have what's called price inflation, and that's what we're experiencing now. The price of gasoline isn't going up because ExxonMobil is evil. It's going up it's very complex, obviously. But yeah, if you've been fed that narrative for a long time, I think it goes against human nature. And people at ExxonMobil aren't evil people. But they're forced into this situation where the price of oil goes up. And I'm not saying that there aren't speculators and all this, but I look towards government as the interventionist in the marketplace that's having the negative impact. And it's complicated, and I urge you to take economics. But for our sake, when we talked about replacing a truck, let's say, remember we were talking about straight line depreciation. If I bought a truck in 1980, right, and I bought a truck for $35,000, and I wanted to, let's say it was probably less than that. It was probably like $25,000 in 1980 for my farm, right? What would I need in 2021 to replace that truck? Well, it turns out 81,000, right? Because the price, the technology of building the truck got better. It didn't get worse. In other words, the costs involved in building the truck didn't go higher. And this is the error in education. You say, well, the price of everything is going up. No, it's not. They have much better methods of building trucks and much better. All of the inputs are actual in real dollars cheaper. Here's the problem right here, 226.7% inflation. And that inflation is caused by the number of dollars that are in the system. So when and I can show you, M2, they don't, M1 chart 2021. M1 is the amount of money the money supply that's out there. You can look. This is from 2020, and it's gone up, drastically. Real M1. Here's from Fred, which I'm not sure I buy Fred's numbers, but nonetheless, here's going back to 1960. So 1971 is when we went off the gold standard, and a lot of the politicians sort of kept those constraints, the golden handcuffs we called them, on for quite some time. Now we get to 2010. Of course, here's that last 2008. These gray areas are recessions. And here we are in 2020. We printed a lot of money. So all that money sloshing around in the economy, and it's chasing fewer goods and services. And the result is obvious: prices rise, and that's why you have. And by the way, inflation is a tax on the poor. It doesn't as much matter to me that gasoline goes from $2.50 to $3.50. It does matter to the fellow, the man or the woman who have to drive to Aspen every day and live down in Rifle because they've been zoned out of living closer to work. Fred is the Federal Reserve. These are their numbers. And you can see how many trillions of dollars have been printed lately. Now, one more thing, and then I'll get into our lecture. We learned about price per earnings, and price per earnings is the price of the stock in terms of their earnings. And so let me show you that PE ratio. PE ratio looks like this, right? Remember, share price divided by earnings per share. So a company earns so much per share, and we're learning this even in our first semester of economics. Well, the PE ratio can be mapped, and it can be mapped out over 500 stocks. This is a basket of 500 stocks, and you can see we're at 38. This high water mark is the dot-com bubble when the stock market collapsed. You can see that we're heading there right now. So the price of stocks versus their earnings is very high as a multiple, right? Because it's the share price as a multiple of earnings per share. So right now, stocks are selling at 38 times their share price. A stock like Amazon's at 800 times their earnings. This is a bad chart. This is a scary chart to someone like me. It's really frightening. It should be to you too. But this is also a reflection of this inflation. When you inflate the currency, people will chase riskier and riskier assets in order to get yield, in order to make money. So they're chasing stocks like Tesla and Amazon and some of these others that really have no business being that high. Bitcoin's a good example of a mania. It's sort of crazy. Okay, interesting. Yes, reach out to me in an email, or if you're confused about what I'm talking about, or you'd like to examine that further, vis-a-vis your education thus far. I can give you books to read. I can give you websites to look at and good explanations. YouTube is an incredible source for a lot of this stuff, and I can point you to the right direction. I did want to show you one book. Robert Higgs wrote this book a long time ago in 1987 concerning COVID and the growth of what I would call the growth of the government in crisis. This book is apropos again, and not that it never wasn't, but Higgs, just to tell you, Higgs receives his PhD in economics at Johns Hopkins, taught at University of Washington, Lafayette College, Seattle University, University of Economics in Prague. He's been visiting scholar at Oxford University and Stanford. He's a fellow of the Hoover Institute, National Science Foundation. He's an Austrian thinker, so he thinks like I do, a free market thinker. But he wrote this book about critical episodes in the growth of American government, and I think that COVID is another critical episode. Usually it's wars, and government ultimately leads to this. Government, government doesn't have. In order to do this, government has to either print money or tax people. Right now, it prefers printing money because taxation is not very popular. But nonetheless, this is not going to go away anytime soon, and no one seems to have a plan to fix it. So it's of grave concern to people like me. It's something to think about as you move through your classes, especially when there is no heterodoxy in college now. It seems like there's only one way to think, and the one way to think is that government knows what it's doing, and debts don't matter and things like that. Well, there's a whole other group of people, who want to debate that issue, and a lot of times they don't get hired. I got hired at a fluke, but myself and very few others within CMC have, understand these ideas and are frightened about the future. So get the education that you pay for. Make sure you get heterodox views, that you get both sides of any debate, and I can accurately debate the Keynesian side of this, and I can steel man it, So and I try to do that in class. Okay, as you can see, back to accounting 121, where I put up some more stuff. I put up chapter 8 and chapter 9, as well as I'm going to put I put up another exam, I think, somewhere. 1 through 4, 5 through 7. Yeah, and then I'm going to put up the exam for 8 and 9 very shortly. We're getting towards the end of the semester. If you're not engaging, it's time to get after it. I can look at student performance here very quickly, and I can tell you that who's where and why and all that stuff. I can get a at-risk report. You can see, look at the class. Most are at risk. And I understand it's a summer class, but 3/4 of you are at risk. So you better get a move on and get caught up. This is not going to be easy at this point. Luckily, hopefully you've got some time in the evenings and stuff to do that. All right, now let's go back to McGraw Hill, and I'm going to go to the library. Oh, I know what I want to do. McGraw Hill home. Here is our course. I'm going to go through chapter 7, and I also have. I know that Ms. Scow had a couple of questions, and I want to make sure that I answer those. And again, you can you please reach out to me anytime. She's obviously going to be out of town and not able to be at class. That's what summer is all about. But I don't know if you just looked at that at risk. I believe she's probably at the top of the class. So let that, if you're competitive at all, which you should be, you want to catch up. Chapter 6. Chapter 6 homework is here. Just thinking. All right, now we've got in our preview, I can go through these. Now, Chapter 6 concerns petty cash and checkbook stuff, reconciliation. It's fairly simple. Again, in a way of homework, it's busy work, really. And it does get a little confusing, as it always does. Here's question 1. And you can see prepared a company check, paid 93, paid 76. Now, what is petty cash for? Well, it's for things that are a pain in the neck to write a check for, or it's people that walk into your business and they want cash. COD, cash on delivery. They want cash today for the services that they render, or you just using it for stamps, or I walk in the office. Let's say I'm the boss, which is laughable, but I walk in and I say, "Hey, Jeff, my fictitious employee who runs the petty cash, go down and get a case of beer, and let's sit around the break room and have a few beers after work tonight. Gosh, it's hot. Everybody's worked very hard." Things like that. That's what petty cash is for. Anyway, see, janitorial, miscellaneous, postage, advertising. You can see, so we had to start the petty cash. We had petty cash and cash. We reduced our cash with a credit, and we increased the other asset account, petty cash, with a debit to increase it. And then on May 15th, we had all these expenses we added up, right? And then we were over short. And which was it? We had $276.99 that we put back into the petty cash we credited $276.99, and we credited our cash over short. So whatever it was, let's see, prepared to replenish to reflect any increase or decrease in your fund balance. Yeah. Okay. So something was wrong and they fixed it. And on May 16th, they added 200. That made the thing, what, 500? I guess. May 15th, paid, 68 paid, postage paid, 300 to establish. What was the 200 paid, reimbursed? I can't see it. Oh, prepared a company check for 200 to increase the fund to 500. Maybe they just started the company and they thought, well, 300 ought to do it. And after a month or so, the management team got together and said, nah, we need more like 500. So let's do that. All right. So there's number 1. 2, no explanation necessary, obviously. Same problem. Same problem. I just wanted you to do it again. Back into it. This one had a $4.48 over short, right? Counted 62.15. Prepared a company check for 200. Replenish the fund for the following expenditures. FOB destination. So that's for freight and things like that. Okay. If anybody has any trouble with this, let me know. I can't remember. Let me check what chapter 5. Oh, chapter 5 homework. I'll have to go back to that one, Betty. And chapter 7 and 8. Okay. There's 2, 3, Same thing, petty cash and cash 350, requirement 2. It just it separated it out. Petty cash payments report, right? A little, what we might call a subsidiary journal to figure that stuff out. And then there's how it got prepare the journal entries, right? So you had this little book that you kept, the subsidiary book that you kept in order to prepare these journal entries, right? So you may keep you might keep something in the safe, with a pencil in order to back up what you're doing. Okay. 4. There it is, chapter 6, petty cash. Same kind of problem with that cash payment report. And there it goes. And then the third one, here they are. Petty cash and cash. They added $100 to it. Okay. Get it up to 500. Here's 5 and 6. Now we have a bank reconciliation. This is the other half, sort of the other half of the chapter 6. We have to reconcile what the books say to what the bank statement says. Reconcile it. So the following information is available to reconcile branch company's book balance to cash and its bank statement to cash. So we start out on, and this is a neat little form they give you, right? This bank reconciliation form. We've got a bank statement balance and a book balance. Right? We know what we got on the books, 25,056 in this case. And then we just start putting this data in there. And we end up with a balance, adjusted trial balance, bank balance of 30,232. There it is. No explanation needed. Again, you should. There's one slide in that stack of slides that I showed on chapter 6 that shows the things that are coming to come out and the things that are going to go in. Insufficient funds or interest payments or NSF, non-sufficient funds checks. And then there's the check that one of your vendors is like got in their pocket and it takes them a month to go deposit it, and it's in transit, so you have to adjust your books to the bank. Okay, no further explanation needed there. There's 7. Chapter 6, homework number 7. Same thing, bank reconciliation. You got a list of information. You're going to go over it one by one to get that balance. Adjusted bank balance should equal the adjusted book balance. Right? What are the adjustments? Well, non-sufficient checks, service charge, an error. Well, we made an error. These are checks that haven't come to the bank yet, right? And it could be a deposit in transit or something like that. We made a deposit on the 31st. It just hasn't hit the bank yet. Number 8. This is Chavez Company recently reconciled its bank statement of book balance, cash. It reported 2 checks outstanding. Following information is available. Here we go. Yeah, you got all these entries, right? Cash payments and entries. Well, they want you to do what they want you to do is prepare journal entries to adjust book balance to cash. Now, what would my suggestion be? Why don't you make one of these? Do one of these on paper. This bank reconciliation on paper, so that you can do this last problem, right? And then you're going to make the journal entries for it. The problem asks for the journal entries. September 30th, nothing required. Why? 30th, interest earned, $12. Deposits, yeah, okay. Our 12 September 3rd total payments. No further explanation needed. Computer equipment, accounts receivable, all those things are there. All right. Now, I'll ask you in class after you've seen this whether there's any questions. Of course, you know, and we'll have time tonight to go over some more questions. Okay, back home. That's chapter 6, and we're about 35 minutes in. That's good. I'm going to jump back to Ms. Scow's question. Chapter 5, 5, 8, and 9. 5, 8, and 9. I promise I put those up. So, and seeing as none of you are really caught up, it won't be bad to look over chapter 5's homework. And here we are. Preview. 5, 8, and 9. I'm going to go right to 5. Right. 5, 8, and 9. So here's 5. And in this, we're in periodic inventory, right? Not perpetual. Following purchases and sales transactions for March. And here it is in, that's in the form that you use for your cheat sheet. And here it is in the software. So, and I'm hoping, Betty, that I nailed it. You know, you see what it is that you did. So we've got it FIFO, LIFO, average cost. And hopefully you'll be able to see where the software is boogered you up. And I don't I don't have I don't have enough experience with it to say, oh, I know what it is, you know, because this is now a new edition of the book. You know, in other editions, I'd be able to say, oh, make sure you do this, and you know, but I don't. I wish I did. Oh, no, we also have specific identification here. Remember, that's a bike you take off. I took that bike and I sold it to Fred, and it's got that serial number, specific identification. So 5, 8, and 9. 5, 8, and 9. So let's go. Here's number 8. Oh, this is a COGS. So Navajo Company's year-end financial statements show the following. They recently discovered making physical accounts, they've made a few errors. Year 1 ending inventory is understated. Year 2 ending inventory is overstated. You know, under and over. Bad. You know, well, no, not as long as you fix it. You know, you count it. Prepare a table and show the adjustments necessary to correct the reported amounts. What's the total error in continued net income for the 3-year period? So here they are. Year 1, year 2, year 3. Corrected amount was 675. You see, subtracted that 53. Make sure you get your parentheses if that's the requirement, because it may still do the. I'm not sure what the software would do. So you can see how these adjustments play out. And in the second, what's the total error combined net income for the 3-year period? Well, it washed itself out. You can see in year 3, right, in net income, it washed itself out. The total net income for the combined 3 year period 802 is not affected by the errors. This is because these errors are self-correcting. That is, I say washed it out. Each overstatement or understatement of net income is offset by a matching understatement or overstatement the following year. So you don't get away with it. You know, it's not like, unless you commit fraud. There's number 8. Let's go to number 9. And we'll get out of here. Again, same one. And I hope that this illuminates that silly red check mark wherever it is. Right. And this one here, of course, it's 0 again. It's a trick question. You got 3 years, so it had to wash out. It's a good CPA question. You know, you'd be losing your mind and you're in that pressure situation thinking, oh, I got to come up with an answer. No, it washes out. Okay. We should be good. It's number 9. Right. And that was all of them. Well, 10 is here. It's just another, you slipped in another inventory question, which is great. There's the explanation of that one for you to look over. Okay, now I'm going to go back over to home, and I'm going to quickly go through chapter 7 so that we're sort of teed up for tonight, and chapter 8. So here's chapter 7 homework here. We've got some in progress, but nobody's really. So what are we doing in chapter 8? Inventory again, right? Oh, this is chapter 7 back. No, chapter 8. I'm sorry. No, I'm right. Chapter 7. Duh. 6 and 7. Here we are. So, chapter 7, following transactions, prepare the journal entries for these transactions. Here they are, right? So, we had these ideas of credit cards and returns and allowance for doubtful accounts. You know, people, you know, we had all these adjustments that we have to make, you know, because of things like credit sales and returns and allowances and products that are damaged, you know, damaged or unsaleable. So as anyone knows from being in business, if you've been in business, not everybody pays you. You know, it's just a part of doing business. You don't want that number to get too high, but you're hoping that you can keep that number really low. So December, this one is for number 2, right? Hot Company reports the following results: 280 in sales, 700 in credit sales, accounts receivable 630, allowance for doubtful accounts. It's trying to get you to understand this bad debt number. Bad debts are estimated to be 4% of credit sales. Show how accounts receivable and allowance for doubtful accounts appear on the December 31st, right? 630 less allowance for doubtful accounts is 23,000. 4% would be like 24,000 minus the 5. You know, it'd be 63 times 4 is something 72. But let me show you. It'll show you here. 4% of credit sales. Estimated 4% of credit sales. Bad debt 7 times 4 is 28,000. Accounts receivable net of 23 uncollectible accounts. Right. So 28 minus 5 is 23. Because we had that $23,000 debit allowance for doubtful accounts. Okay. Clear as mud. I think that one's good. 3. Same idea, trying to get you to learn how to do this. Bad debts are estimated to be 1.5% of credit sales, 1% of total sales, aging analysis. So it gets you to do it 3 different ways from Sunday. And here's the calculations involved in those methods, right? And when you're going to start a business, or you're working for someone, or you're working for a big corporation, you may get a chance to have an opinion on what method that you use. Here's number 4. Aging analysis estimates 5% of year-end accounts receivable are uncollectible. Show how AR and the allowance for doubtful account appear on the balance sheet. And there's your answer. The explanation, of course, $1.2 million times 5% is 63.5. All good. 3, 4. And we have number 5 here. Here's some information. Unadjusted credit balance of 14.5. Credit balance. Jardin prepares a schedule of December 31st accounts receivable by age. Right? Expected percentage of uncollectible by age. 1 to 30, 30 to 60, right? This takes into consideration that the further people get away from a debt time-wise, the less likely they are to pay. This is psychological. So there's number 4. Number 5, on June 30th of next year, Jardin concludes that a customer's $3,150 is uncollectible and amounts written off. Does this directly affect their net income? No. Well, why? The entry to write off an account involves a debit to allowance for, doubtful account, and a credit to receivable, both of which are balance sheet accounts, right? It didn't affect net income. Net income is affected only by the annual recognition of the estimated bad debts expense, which is journalized as an adjusting entry. So that's a nuanced difference between balance sheet and income statement. So which would you rather do? And that's a question. And as a stock analyst, I might look at that, and say, well, maybe they need a better method or better estimation of their doubtful accounts if their balance sheet's taken a big hit. Don't know. Believe me, that for a company like a highly actively traded company like Amazon, there are analysts like myself that are looking very, very closely at those numbers as an indicator maybe of some kind of fraud or massaging the numbers or something in that area. And make no mistake, I'm an Arthur Lev guy. I think that accounting is in deep trouble. I say that not tongue in cheek. I say that very soberly to say I think accounting is in real trouble because there's flagrant dishonesties and there's nuanced dishonesties, which are the same damn thing, involved in making some of these educated guesses. So there should be less guessing. Let's put it that way. Because guessing tends to, in economics, we talk about incentives matter. And if you incentivize CEOs or CFOs to guess, they'll guess in their own favor. On December 31st, Jardin allowance for doubtful accounts was an unadjusted credit balance of 14.5. They prepare a schedule of the receivables by age, same problem. Prepare the adjusting entry to record bad debts as of December 31st. Right? Expense, right? This is an income statement. Allowance for doubtful accounts is there. Right? So here it is. Unadjusted balance was 14.5. Estimated balance 41,650, and the required adjustment of 27,150. You're backing into that number to make that adjustment. Just like we've made so many other adjustments. You just get good at visualizing that in your head if you just do it over and over. T accounts really help. If you put things in T accounts and you say what should the balance be, right? There's what the balance is, what should the balance be, and then do the arithmetic for the adjusting entry. Number 7, bunch of information, number of transaction or sales on credit. They want journal entries of year 1 and year 2. There they are. There's year 1, and that's year 2. Okay, again, this is year 2 you're looking at. And here's the explanation. Slowly. In year 1, the receivables were 0. There's our credit sales, our collections, our write-off, ending receivables. In year 2, we had beginning receivables of 652. Right? And then we figured the percent uncollectible here, right? So again, there's year 1, bad debt expense, allowance for doubtful accounts, 31,892. In year 2, bad debt expense, 30,000. So better. Is that good? Yes. Right? Is that if you're running the business, you think, okay, we did a little better. Question 8. Same idea. Virtually, there's year 1, 28,169, and up to 32. Is that bad? I don't know. Is it a bad year? Right? You want to be able to explain that number. Again, there's year 2, 32. There's year 1 at 28. So we had AR and sales, COGS, inventory, right? And here's the explanation of that one. Same question, redundant. If you do these enough, you begin to understand them. And you get one right, and then you go back and go, okay, what did I do there? Keep notes. I think that's powerful. 9. Right? Once again, this one's a little more complicated. First, complete the table below to calculate the interest amount. Right? Year 1 accepted a 10,960 days 7% note, granting Danny Todd a time extension on his past due account. Right? Remember this? I went through it in class. I hope I nailed it in a lecture where you go, some people will come back and go, can I negotiate my outstanding debt and my outstanding bill? Some companies will do that, some companies won't. But nonetheless, here's this note to calculate the interest amount, principal 10,900, interest recognized at 31st, 7%. That's big. The time is 63/60th, and the interest on the 31st was 15 days. So the total interest is $127. On the 31st, it'll be $32. Okay, so 1A to D, there it is, $32. And there's 1B, right? Just the same kind of adjusting entry you might make for salaries or something on the 31st, right? This is the first few weeks of class where we're learning that, oh God, we got to do all these damn adjusting entries to make, to straighten up the books. There's 3, and this is through maturity, where they gave you this neat little graphic to fill in this sort of subsidiary journal, right? To fool around with this so you get it right. You know, you're just basically checking yourself. And there's and here's what it looks like, one transaction at a time. Let me get this straightened up. Use the calculated values to prepare your journal entries. 96 and 32, right? There's your interest and the receivable. And then you're going to turn around and get rid of that receivable. Right? Simple enough. Looks scary, but it's really not. If OM pledged its receivable as security for a loan for the bank, where on the financial statements does it disclose its pledge, right? Your stockholders or your investors need to know that you're having trouble. That's not something you want to be doing, but it's one thing you can do. You pledged your receivables as security for a loan. Why'd you need the loan? Well, we're expanding. Can you explain it? Can you explain it to me if I'm on the board at a level where I can go, okay, that's a smart move. Let's do it. You know, the future income makes taking this risk worth it. That's a good question. In general, I don't want to do that. Okay, and here's the explanation for all this. Let's see what they say. When a business pledges its receivables as security for a loan and the loan is still outstanding at period end, the business must disclose. This is a requirement because the business committed a portion of its assets to cover a specific portion of its liabilities, which means the business dishonors its obligation. The creditor can claim the amount. Yeah, they didn't editorialize the way I did. I gave you my opinion. I don't think that's a great idea. Okay, I'll just show these one more time. Here they are. So you can stop and look and do all that and compare it to your work. Okay, and off we go to number 10, the last one in this chapter. And I think it's about 1:15, so I'm going to be up in Aspen at, I don't know, 4:30 or 5 or something. I'm going to go up there early because I want to make sure the equipment's working this time out. Okay, year one. Got a lot of information. This is OM. Use 360 days in a year, right? That's banking. We use 365 for ratios and metrics and things like for that. But for banking 360, I don't know. Why that is. Somebody came down from the mountain with that on gold tablets. Accepted a 10,000 60-day 8% note. And this is great because it's getting you to. It's not only have I introduced you to the interest rate, and I just discussed it in my opening lecture on this tape to try and get you to understand that if the Federal Reserve is manipulating interest rates and they manipulate them north, which I disagree with fundamentally, the price of money should not be messed around with by a government. And if you say to me, well, the central bank is separate from the government, I would argue that that's not true. However, whether or not we can debate that point is a whole different animal. But when you set, and the Federal Reserve doesn't set interest rate, they manipulate the bond market through purchases and selling of bonds. They call it open market operations in order to push interest rates to and fro. What you have is distortions in a market. And now that you are looking at notes receivable and notes payable and things like that, you can see that interest rates are wildly important to how businesses function. What is not notice, when interest rates are low, it's really wonderful for borrowers, but it's terrible for savers. It's terrible for, and again, I'll call it a tax on the poor. People in the less fortunate people who want to save money and get ahead in the world, because Social Security goes away. You don't get to create wealth that way. So savings is the only way to create wealth in this country. If you lower the interest rate to near zero, people don't get to save. They don't get a return on their savings, and that's to me, that's a tax on the poor. And I think that any thinking person would probably agree with me. So here's year one, year two, and here's the requirements. Table below to calculate the interest amount, right? There's that 36 and 144, and that's going to be the total 36, right? So, the first, your journal entries for year one, right? That's year one, 10-8, and then you got that receivable, that $36 in a receivable. Okay. AR. So that's an asset. You earned it already. And here it is again, principal, rate, time, total interest. 123, year two. So 186 is the Mulan note, the Carson note, September 3rd of year two, 35. We have these two notes that we're messing around with. Here's what it looks like journalized, right? Journalize these entries, right? We have a receivable and we have revenue, on February 14th. So it's 10,800. D Todd, and then there's Privet, and then there's, notice they put these in the notes to keep it straight so you don't get confused. And your drop downs all have those in there, so but you're getting used to sort of formatting it. If you're doing your books for your business by hand, it depends on you how extensively you want to be using that type of detail. If it was me and Kelly, my wife, what do I need to tell her in this journal or in this ledger in order to in this journal, in order that she understand what I'm presenting, because we're communicating in this language, right? And I want to make sure she can absorb it and understand what the hell's going on. Okay. And here we are in the last one. Financial statement footnotes is where that would go, of course, because yikes, security, right? And here's the explanation for you. It goes through the math and just what you're going to have to understand. And if you don't get that information, reach out to me. And I just don't get interest rates, and the time value of money and things like that. This is the basis of business, and this is why you take accounting early on in your business education, so that now you're ready to go into a finance course and go, oh yeah, okay, time value of money reflected in the interest rate. I get it. I know how to account for that. I know why it fluctuates. Risk is a deeply psychological idea that pushes the interest rate to and fro. Again, I'll make a plug for Peter Bernstein's book, Against the Gods. If you want to do more to understand risk, and I'll show you that. Understanding risk is, oh look, is it, they have a PDF? No, can't be. Peter Bernstein, maybe WordPress? Nah. how many pages is this? 9, no. Right? Mastering risk is what separates modern times from the past. Risk management guides decision-making by identifying what may happen in the future and looking at alternatives, right? The first real study of risk began in the Renaissance. He goes through the history. It's really fun, especially if you enjoy history. Right? The theory of probability provides a mathematical definition of risk. Controversy between two groups. Those who believe best decisions are based on numbers. Those who base their decisions on more subjective beliefs about an uncertain future. Okay. This is the divide that occurs. Fish are black of Black Shoals. Markets look a lot less efficient from the banks of the Hudson than from the banks of the Charles. That's a very interesting statement. Much more free market kind of an outlook on the banks of the Hudson. So anyway, that's a great book. If you want to pick it up somewhere, I think it's a very worthwhile read and an interesting read. You know, not all business books, you know, I don't want you to have to suffer through a book, especially in the summer. The Crisis in Leviathan, I think is worth it. It's if especially read this book if you fancy yourself a socialist, or you fancy yourself as whatever a social democrat is, or you know you're okay with government spending. I'm not trying to talk you out of it. I'm just saying that you ought to educate yourself as to how the other side thinks, so that at the very least you can make a measured and strong argument for your position. So, okay. With that, I'm going to shut her down. It's 1 o'clock, so I went for about an hour. That's perfect. I will upload this rapido and put it up on Canvas for you to take a look at. See you all tonight, and enjoy the tape. I hope you got something out of it. Thanks.